Welcome back to Investing Talk podcast.
Good to be here.
Today we're jumping straight into, well, a pretty challenging and high-stakes sector. We're looking at a company that seems to be doing a masterful job navigating some unique complexities. Tilray Brands.
It's definitely one that's been on a lot of radars.
Absolutely. And our mission today is really custom tailored for you, our listeners. We've gone through your stack of articles, research notes, and we're synthesizing the fundamentals, the technical trends, and importantly, the major near-term catalysts.
All to answer that one big question. Right?
Exactly.
Right.
Is Tilray Brands a good time to buy now? We want to give you the clearest possible picture from the data available right now.
Okay.
And just before we unlock these sources, please remember to subscribe, like, and comment on the review. It really helps us know if we're hitting the mark for you.
Yeah, let us know.
And hey, if you have a specific company you want us to look into next time, just leave a comment below. We do read them.
So when we aggregate all the material you sent in, what emerges is a portrait of a company that's really building operational resilience. And that's in a sector traditionally defined by volatility.
Right. Resilience is the key word.
It is. Tilray Brands is focused hard on diversification, while at the same time striving to maintain its leadership position, particularly in Canada.
So the overall feeling from the sources.
The overall sentiment, after balancing the risks and the opportunities detailed in everything we looked at, it's undeniably bullish.
Bullish, okay.
Yeah, we pegged the consensus rating at a strong 8.5 out of 10. But look, a rating that high requires a deep understanding of how they're actually pulling this off. How are they achieving this resilience in their core operations?
Okay, let's unpack that then. Let's start with the core financial engine. I mean, despite all the headwinds facing the legal cannabis market, the company's top-line revenue shows some significant staying power.
It really does.
For the full fiscal year ended May 31st, 2025, revenue clocked in at, $693.58 million. Pretty impressive.
Yep, almost $700 million.
And if we zoom in on the most recent quarter, Q1 of fiscal year 2026, revenue was $184.12 million.
Okay.
Now, what we found in the sources is that this is an increase of nearly 11% year over year.
And that growth isn't just like organic cannabis sales bumping up slightly, is it?
No, exactly. It's largely supported by that expansion in their non-cannabis beverage segment that's proving to be a fantastic stabilizing force for them.
Right, the Sweetwater effect and others.
Precisely. And it's also worth noting, analyst consensus is even more optimistic. They're projecting next quarter's revenue growth will actually accelerate above 15%.
Wow, okay. So they expect those recent distribution deals to really kick in.
Seems like it.
Now, what's fascinating here, I think, is how they're managing their operational structure. Getting meaningful margin improvement in a high-cost environment like Canada, that's tough.
That is. What are the margins looking like?
They boast a gross margin of 31% in Q1 FY 2026.
30.
Yeah, and this isn't just a decent number. It's robust. And critically, it's above many of their direct North American cannabis peers.
So they're managing costs better, despite things like high Canadian excise taxes.
That's what it suggests. Efficient management of cost of goods sold, even with that regulatory overhead.
Yeah.
And this operational edge, it's directly translating to the bottom line.
How so? Are they profitable yet?
Not yet, but getting closer. Specifically, the sources confirmed their net loss narrowed significantly in Q1 FY 2026. It shrank to $32.1 million.
Okay, down from
$42.8 million the year prior. So that's steady sequential progress. It confirms cost controls and operational efficiencies are starting to, really bite.
And the long-term view?
The long-term trajectory, which is vital for any investor considering this, forecasts eventual positive earnings per share EPS.
When are they forecasting that?
Looks like fiscal year 2028 onward is the consensus there. So it's moving them away from just being a speculative growth company toward one with a realistic path to actual profitability.
Okay, profitability on the horizon. But stability now is key, right? Especially in this sector. The sources seem to emphasize Tilray's strong liquidity position.
They do. That's a big plus.
As of August 31st, 2025, their cash and cash equivalents totaled $268.1 million.
$250 million cash pile. That's a real safety cushion.
Yeah, it allows management to make strategic moves, right? Like acquisitions or international expansion without maybe relying on highly dilutive share offerings right now.
Exactly. Flexibility.
Furthermore, they maintain a healthy current ratio of 1.9x.
Which is good short-term liquidity. They can cover their immediate bill.
Right. But here's maybe the most important metric for understanding their self-sufficiency. They generated free cash flow of $21.5 million in Q1.
Okay, let's quickly define that for clarity because it's crucial. Free cash flow, or FCF, that's the actual cash left over after they've paid for all their capital expenditures, buildings, equipment, all that.
So it's the real measure of financial health.
It really is.
Yeah.
It shows their ability to self-fund growth without tapping outside sources, generating over $21 million in FCF in a single quarter in this specific sector. That's a serious marker of maturity.
Okay, that sounds positive, but we need to inject some critical perspective here. Their total debt stands at $527.8 million. Wait, $500 million in debt. That sounds substantial.
It does.
What's the worst case scenario if, say, U.S. regulatory reform just stalls indefinitely? Can they handle that debt load?
That's a fair and necessary challenge. And while the absolute number, $500 million, sounds large, the sources highlight that their leverage is considered manageable relative to the sector.
Okay, relative is the key word.
Exactly. We look at the net debt to EBITDA ratio. EBITDA being earnings before interest, taxes, depreciation, and amortization. It's a proxy for operational earnings power.
And that ratio is?
It's around 2.8x. Generally, a ratio below 3x is seen as pretty healthy. And being below the sector average suggests their cash flow generation is robust enough to service that debt comfortably, even in a tougher economic environment.
So it's leveraged, but maybe intelligently managed leverage.
That seemed to be the consensus. It's aimed at funding that diversification we should probably talk about next.
Right. Let's move beyond the raw financials then, because the real reason for that 8.5 out of 10 bullish rating, according to the sources, seems to be their strategic structure, their competitive moat.
Exactly. Tilray brands didn't just survive the cannabis shakeout. They established themselves as the largest cannabis-branded company in Canada. They hold dominant market share in high-margin categories like flower and pre-rolls.
And that leadership gives them pricing power.
It seems so. They could potentially avoid some of the really cutthroat price wars that are plaguing smaller, more regional competitors up there.
Now, here's where it gets really interesting for me. The diversification strategy. It feels like it flips the traditional cannabis risk profile on its head.
How so?
Well, they've built up this unique beverage and alcohol portfolio. It includes well-known names like Sweetwater Brewing, Breckenridge Distillery.
Right, these aren't just random assets thrown together.
No. And the sources confirm this portfolio acts as a crucial shield. It actively, quote, protects revenue against cannabis market volatility. That seems paramount in a sector subject to political whim.
Absolutely. And crucially, this strategy also creates unique cross-segment synergy.
Like what? How does that work in practice?
Think about distribution. Sweetwater, for instance, already has established shelf space, relationships with major retailers, distributors across North America, stuff that's hard to build.
Okay.
Tilray can potentially piggyback on this existing, established alcohol distribution backbone. They can use it to launch new, maybe low-THC beverages or wellness products, bypassing the massive startup costs and regulatory hurdles a pure-play cannabis company would face.
So they leverage the existing network. That makes sense.
And if we connect this to the bigger picture, this whole strategy is proactive risk mitigation. They're investing heavily in international markets to Germany, the UK, and in these adjacent sectors, precisely to mitigate that ongoing regulatory lag in the US.
So they aren't just sitting around waiting for Washington, D.C. to make a move.
Exactly. They're building a global, diversified revenue stream now. This combination sector leadership plus diversified assets is what drives their reported margin resilience. They have a loyal customer base across 3 different product verticals now: medical cannabis, recreational cannabis, and traditional beverages.
And their innovation seems to be happening right at the intersection of these areas.
That's right. The recent introduction of new THC-infused beverages, wellness SKUs, they're leveraging that beverage expertise. It positions them ahead of shifting consumer demands.
So essentially using their established lower-risk beverage brands to kind of test the waters for future, maybe higher upside cannabis products globally.
That seems to be the play. It's quite clever.
Okay, let's shift focus now. What are the charts saying? What's the investor belief looking like? The price action seems to confirm a distinct bullish structure right now.
Yeah, the technicals look strong on the surface.
The stock has formed a pattern of higher lows and higher highs. It moved sharply from an early July 2025 low of, $1.05 up to $1.85 by late September.
That's a significant run in just 3 months. Confirms strong underlying momentum.
So momentum traders must be watching that key resistance zone, right? Between $1.90 and $2.10.
Definitely. That level's been tested multiple times recently. So if the price punches through there convincingly,
It could signal a bigger breakout?
high probability, yeah. Towards the next major psychological level, maybe $2.50 or higher. And crucially, the stock is trading well above both its 50-day and 200-day simple moving averages.
Explain why well above matters there.
Trading well above these averages means institutional investors likely believe the long-term trend, that's the 200-day, and the medium-term trend, the 50-day, are firmly positive. They're willing to buy at prices significantly higher than the average cost over the last, say, 2 to 6 months.
Okay, but this raises an important question, doesn't it? Is the stock getting ahead of itself after such a big run-up?
That's the caution flag momentum buyers need to watch. When we examine the technical indicators, the 14-day Relative Strength Index, or RSI, sits at 74.97.
And RSI measures.
Speed and change of price movements. A reading above 70 is generally considered overbought.
So it's in that zone, potentially frothy.
It's approaching that overbought territory, yeah, which signals caution for, maybe short-term entry points. But what's key here, according to the sources, is that the strong momentum seems confirmed by consistent accumulation, not just speculative froth. Meaning the short-term volatility, measured at around 10.7%, is actually quite stable compared to the broader sector. This suggests more sophisticated buyers are entering the stock, likely based on those underlying fundamental improvements we just discussed, not just chasing hype.
And who are those sophisticated buyers? Are we seeing confidence signals from insiders or institutions?
We are, and this is quite encouraging. Insider activity is highly positive. The sources confirm the CEO and multiple board members increased their holdings in August and September 2025.
And they were buying during market dips,
Right.
specifically.
Yes, that's noted. When the people running the company put their own cash into the stock at current prices, especially on dips, that's perhaps the clearest vote of confidence you can get, right?
It really is. And institutions. Are they following suit?
Aligning perfectly with that is the institutional endorsement. We saw significant institutional inflows reported, with major funds, Vanguard, BlackRock mentioned, specifically adding to their positions in September 2025.
Okay, so when institutional money follows insider conviction.
It means the bullish thesis isn't just supported by chart watchers. It's backed by fund managers doing serious due diligence on those fundamentals. It adds weight.
All right, looking ahead then. What are the near-term triggers, the catalysts that might justify this momentum and potentially provide more spikes?
Okay, there are several confirmed near-term triggers. First, that Q1 2026 earnings beat we mentioned. It resulted in management actually raising their full-year guidance for beverage sales.
So they're executing better than expected in their most resilient segment. That's good.
All right. Second, that major partnership announcement in September 2025, the exclusive beverage distribution deal with Walmart Canada.
That sounds big.
It is. It's expected to significantly boost retail volumes, not just for their alcohol brands, but it also builds the framework for future wellness product placement. Getting into Walmart is a massive stamp of approval.
And that should impact Q2 earnings.
Directly. So key dates approaching are the Q2 FY 2026 earnings release, probably late November 2025, that will reveal the initial impact of the Walmart deal. And also, the specific THC beverage rollout in Canada is set for October 2025.
Okay, those are confirmed catalysts. What about the more speculative stuff, the high upside rumors that often drive short-term price action?
Right, this is where things get a bit more, speculative, but they definitely influence sentiment. The most persistent buzz involves a possible acquisition.
By who?
Molson Coors is often mentioned, or another major beverage giant. The idea is that the success of the Sweetwater acquisition and the demonstrated cross-synergy have made Tilray brands a very attractive target.
Like a pre-built pathway into the future regulated THC market for a big beverage company.
Exactly. And that M&A speculation definitely ramped up after the Walmart deal because it proved the combined entity can move product at scale.
Makes sense. What's speculative buzz number 2?
That's the foundational upside driver for the whole sector, really. The early chatter about expansion into the U.S. cannabis market pending federal reform.
Ah, the Schedule 3 potential.
Precisely. Any material progress on the DEA Schedule 3 ruling the potential move to reclassify cannabis remains a pivotal rumor. If that happens, Tilray, with its operational base in cash, would arguably be perfectly positioned to rapidly enter the U.S. market.
Which would unlock massive potential revenue streams basically overnight?
Potentially, yes. That's the big what if.
Okay, finally, we have to acknowledge the elephant in the room here.
Right.
The reverse stock split.
Right. Shareholders approved a resolution for one earlier this year in a ratio up to 1-for-20.
Why did they need that?
It was mainly to help maintain their Nasdaq listing. There are minimum price requirements and also to attract institutional interest. as many funds have rules against holding stocks priced below, say, $5 or even $1.
But implementation is paused now because the price recovered.
Correct. It's currently paused because the price got back up towards $2, but it still kind of hangs over the shares. The wild card. Management could implement it quickly if the stock price drops again.
And reverse splits often carry a stigma, don't they?
They sometimes do in the retail investor community, historically speaking, so it's a factor to be aware of.
Okay, so lots of potential upside, but let's balance this. We cannot ignore the inherent risks, especially in this sector. What are the key ones highlighted in the sources?
Well, the primary company-specific risk, despite the improving margins and narrowing losses, is that Tilray Brands is still operating at a net loss.
Right, profitability risk.
Exactly. And achieving that profitability depends on two things: continued successful sales growth and a favorable segment mix, meaning those higher margin beverage and wellness products need to keep growing faster than the core cannabis segment.
And there's also execution risk, right? Launching new products, making those synergies actually work.
Absolutely. New product launches, like the global THC rollout, achieving those crucial cross-segment synergies between cannabis and alcohol that requires flawless execution by management. If synergies don't materialize, or if new product launches fall flat, that path to FY 2028 positive EPS could definitely be delayed.
Okay, those are company risks. What about broader sector and regulatory risks?
The big one is regulatory risk. It's persistent and overriding. Cannabis remains federally illegal in the U.S.
So even though Tilray is smart to diversify internationally,
Potential delays in U.S. reform could still cap that massive upside potential that currently dictates a lot of their valuation premium. If the Schedule III ruling gets postponed indefinitely or watered down significantly, investor enthusiasm in the entire sector will likely wane, dragging down even resilient players like Tilray.
and just general market volatility.
Yes. While Tilray has outperformed peers recently, the broader cannabis market remains structurally volatile and highly competitive, especially in Canada. They face ongoing competitive pressure on pricing, and any macroeconomic headwinds could trigger broader market sell-offs that impact even financially stable companies. These aren't immune.
Okay, so putting it all together, what does this mean for you, the listener, considering Tilray right now?
Well, the sources, taken together, present a deeply compelling case. It's based on that operational resilience, the strong liquidity, remember that $268 million cash cushion, and a clear, bullish technical trend.
And that trend is being supported by both institutional and insider buying, which adds conviction.
Right, so the investment thesis, according to our analysis of the materials, really breaks down into two distinct horizons.
Okay, what are they?
Short term, the stock looks highly attractive for momentum traders. They'd be focused on those confirmed Q4 2025 catalysts, the Walmart deal impact, the THC rollout, the upcoming November earnings report. There's potential for near-term pops.
And the long-term view.
Long-term, Tilray Brands seems uniquely positioned for structural growth. There's potential multi-bagger potential here, expected as those significant regulatory catalysts like U.S. reform or M&A catalysts finally unfold over the next, say, 3 to 5 years.
So two different ways to potentially play it.
Exactly. Now, considering that concentration of institutional and insider buying, combined with the approaching Q2 earnings report, which is the first real measure of that Walmart partnership,
Yeah.
the critical question for you to mull over is this. Knowing their operational resilience is proven, how much of the rumored M&A upside or that potential U.S. regulatory progress is already built into the current $1.85 app price?
Good question. How much is priced in?
And what specific data points in that November earnings report may be a big jump in their free cash flow or confirmation that gross margins are holding up strong? What specific data points would cause you to either double down on your position or perhaps pull back and wait?
That's the key test of investor confidence for the next few months then.
Absolutely. That's what you need to watch.